Right now, somewhere in America, a 34-year-old is logging into their Fidelity account, checking their 401k balance, and feeling pretty good about themselves. They've been doing everything right. Low-cost index funds, automatic contributions, set it and forget it. The responsible adult thing, and they have absolutely no idea that the system they trust most is the same system currently being engineered to hand them the bill for the largest wealth transfer in modern financial history. Because here's what nobody in traditional financial media will say out loud. Passive investing, the thing sold to you as the democratization of wealth, the triumph of the little guy over Wall Street's overpaid stock pickers, has a second function. One that nobody mentioned in the pitch. And that function is this. It turns your retirement savings into guaranteed, automatic, no questions asked exit liquidity for whoever can get their stock into the index. And right now, somebody very powerful just figured out exactly how to do that at a scale we've never seen before. But to understand how we got here, you first need to understand what passive investing actually is. Because most people think they understand it. They don't. Not really. Not the part that matters. When Jack Bogle launched the first index fund in 1976, Wall Street laughed at him. The idea was simple. Instead of paying a fund manager to try to beat the market, just buy the entire market, every stock, in proportion to its size. Hold it forever. Charge almost nothing. The pitch was elegant, and it worked, because the data was brutal and clear. Over any 15-year period, roughly 90% of actively managed funds underperform the index they're trying to beat. Not because the managers are stupid, because the fees compound against them every single year until the math becomes impossible. So the money moved, slowly at first, then all at once. Because in 2009, after the financial crisis, retail investors had watched their actively managed funds crater while still paying 1.5% fees for the privilege, and they were done. The passive investing revolution accelerated, and it never stopped. Today, more than 63% of all US stock funds are held by passive indexers. That's more than $13 trillion of capital that wakes up every morning and buys whatever is in the index. No analysis, no valuation, no opinion, just automatic, mechanical, rules-based buying forever. And this is where the second function begins. Because here's the thing about an index that nobody told you. When a stock gets added to the S&P 500 or the Nasdaq 100, every single fund that tracks that index is legally required to buy it. They don't get a vote. They don't get an opinion. The stock gets added and the money flows in automatically. We're talking billions of dollars of guaranteed buying demand, created the moment a company crosses the threshold, which means getting your stock into the index isn't just a badge of honor. It's access to the single most reliable, most predictable, most mechanical pool of capital on earth. And if you're an insider sitting on billions of dollars of shares in a company valued at a price you weren't sure the market would sustain, that guaranteed buying demand would look very, very useful. Now let's talk about how the game is actually played, because this isn't a new concept. The mechanics of using index inclusion as exit infrastructure have been running quietly in the background for years. It just hasn't operated at this scale before. Go back to 2020. Tesla gets added to the S&P 500 in December. In the months leading up to inclusion, Tesla's stock had already run up over 600% for the year. The valuation was astronomical by any traditional measure. Price to earnings ratios that made veteran analysts visibly uncomfortable on camera. And yet, passive funds were required to buy it anyway. Not because they believed in the valuation, because the rules said so. And in the weeks around inclusion, Tesla absorbed somewhere in the range of $80 billion in passive fund inflows. $80 billion of retirement account money automatically deployed into a stock at or near its peak price because an index committee made a decision and the mechanics did the rest. Elon Musk sold roughly $15 billion in Tesla shares in the months that followed. Now, I'm not saying that was coordinated. I'm saying the structure made it possible. The index created the demand. The insider had the supply. The retirement accounts absorbed it. That's the pattern. And once you see it, you cannot unsee it. Which brings us to what's happening right now, in 2026 with SpaceX. Because everything we just described is about to happen again. Except this time, it's been engineered from the beginning. And the numbers are so large, they should make you uncomfortable. SpaceX is preparing for an IPO at a target valuation of $1.75 trillion. To put that in perspective, that's more than every American defense contractor combined. More than Coca-Cola, McDonald's, Disney, Nike, and Starbucks all put together. More than the top 10 companies on the London Stock Exchange combined. And here's the part traditional financial media keeps bearing in paragraph 8. SpaceX lost nearly $5 billion last year. Now, there's a version of this story where that's fine, where the losses are temporary, where the growth justifies the valuation, where the rockets and the satellites and the AI ambitions all compound into something worth $2 trillion eventually. That version exists. Reasonable people believe it, but that's not the version we're here to talk about. We're here to talk about the mechanism, because regardless of what you believe about SpaceX's long-term prospects, what happened on May 1st of this year was not a business story. It was a plumbing story. On May 1st, Nasdaq quietly adopted something called the fast entry rule. And with SpaceX reportedly targeting a June listing date, the timing for this new rule is what you might call extremely convenient. Under the old rules, a newly listed company had to wait at least 3 months before it could be added to the Nasdaq 100 index. That waiting period existed for a reason. It was called price discovery. It gave the market time to figure out what the stock was actually worth before $600 billion of passive fund money was mechanically forced to buy it. The new fast entry rule cuts that waiting period from 3 months to 15 trading days. That's 3 months of price discovery compressed into 3 weeks, which means SpaceX goes public, and before the market has had any real time to form an opinion, the passive funds are already being required to absorb billions of dollars of shares. But the waiting period wasn't the only thing that changed, because there were 2 other rule changes buried in the same announcement, and they're actually more important. Under the old rules, a company needed at least 10% of its shares actually available to the public to be added to the Nasdaq 100. This is called the free float requirement. SpaceX is targeting a free float of 4 to 5%, which means under the old rules, they wouldn't qualify. Full stop. Automatic disqualification. Under the new rules, the minimum free float requirement is gone entirely. And then there's the multiplier. Because buried in the technical language of the rule change is a provision that for companies with a free float under 20%, Nasdaq now treats the float as 3 times larger than it actually is. A 4% float gets weighted as if it were 12%. A 5% float gets weighted as if it were 15%. So to summarize what just happened, we shortened the price discovery window from 3 months to 3 weeks. We eliminated the minimum float requirement that would have disqualified SpaceX entirely. And we introduced a multiplier that artificially inflates the apparent size of a tiny float to manufacture index weight. The runway was cleared, the red carpet was laid out, and the passive funds are standing at the door with $600 billion waiting to be deployed. Now, here's where this gets personal. Because you might be sitting there thinking, this doesn't apply to me. I don't own Nasdaq ETFs. I'm not buying SpaceX. And to that I would say, check your 401k. Because if you hold any broad US stock market index fund, any S&P 500 fund, any total market fund, any retirement target date fund, and you almost certainly do, there is a very high probability that within a few weeks of the SpaceX listing, you are going to own some SpaceX stock.